After determining the optimal allocation across asset classes, it then becomes important for an investor to be able to evaluate their performance. We've previously looked at portfolio evaluation, but in this particular case we're going to look at portfolio attribution that enables us to identify the exact cause of over or underperformance by disaggregating between asset allocation and security selection. So the process of portfolio attribution is all about decomposing overall investment performance into its components. And the two components are the two main decisions that's made by portfolio managers, that is the security selection decision and the asset allocation decision. Portfolio attribution is really all about a process of benchmarking. So an investor will select an appropriate benchmark, whereby that benchmark will comprise both the benchmark asset allocation decision and the benchmark return within each asset class. Once that benchmark is created, that's often referred to as a bogey portfolio and is used as a measure of expected returns for each of the asset classes. So in order to attribute performance to its components, the investor must calculate the return on the bogey and the return they generated on their managed portfolio, and use this to explain the differences in returns based on either the weightings across asset classes, which is the asset allocation, or the returns within each asset class, which would be differences due to security selection. Let's look at an example to see how this is done. So in this particular case, let's imagine that our bogey or our benchmark portfolio is one that has 60% invested in equities, 30% in bonds, and 10% in cash. And let's imagine the market index return across each of these asset classes is 5.81% in equities, 1.45% in bonds, and 0.48% in cash. So we can use our normal return calculation, the weights times return of each asset class, to see that the bogey or the benchmark portfolio generated a return of 3.97%. Now let's consider that the fund that we're managing in this period had generated a return of 5.34%. So that means we've outperformed the bogey, we've outperformed the benchmark, and the measure, the degree of that outperformance was 1.37%. The first step is good news. We've seen we've outperformed the market, but the next step in portfolio attribution is to decompose that 1.37% to identify what proportion of it is due to asset allocation and what proportion is due to security selection. So first of all, in order to determine the contribution of asset allocation, what we need to look at is the actual weights across each asset class within our portfolio compared to the weights in the benchmark. What we can see here is that we've overweighted equity by 10%. We had 70%, whereas the market had 60%. We've underweighted fixed income by 23%, and we've overweighted cash by 13%. So these are our excess weightings. Now, because we want to look at, in this first part, just the contribution to overall underperformance by asset allocation, we're not going to include any security selection. We're going to ask, well, imagine if each of these asset classes we had have invested in the market such that we imagine we had have generated the market return for each. By looking at what effect we would have by generating the market return, what we're really calculating is the impact of these overall underweightings across each asset class. So we overweighted equities by 10%. That asset class generated a market return of 5.81%, so that contributed 58 basis points to our overall return. We underweighted fixed income by 23%, so minus 0.23, times it generated a return of 1.45%, that dragged down our performance. We overweighted cash by 0.13, it generated a return of 0.48, so the contribution to overall performance of that overweighting was 0.0624. And if we sum all these together, we can see that the overall contribution of asset allocation to our performance was about 0.31, 31 basis points. So of the 1.37% overperformance we saw on our previous slide, 31 basis points can be attributed to asset allocation. So the balance must be attributable to security selection. And let's have a look at this. So we can see here that for security selection, now what we know here, I haven't included cash because we don't really have security selection in terms of cash. We just invest in the cash asset class. So security selection is relevant for both equities and fixed income. And what I've got here is the return that we generated within each of those asset classes. So we generated a return of 7.28% in equities and 1.89% in fixed income compared to the relative benchmarks. So what we can do is we can look at the excess return performance in each asset class. In equities, we outperform the market by 1.47%. In fixed income, we outperform the market by 0.44%. Now we know that equities comprise 70% of our overall portfolio. So we outperform by 1.47% within an asset class that comprised 0.7 of our overall wealth. Hence that contributed 1.03% to our overall outperformance. In fixed income, we overperformed by 0.44%, although fixed income only comprised 7% of our total investment. Hence, that contributed 0.03% to our overall outperformance. Again, we sum those up and we can see the total outperformance attributable to security selection is 1.06. So if we go back, we can see that we've decomposed this overall outperformance of 1.37% versus the benchmark into two components. But 0.31% can be attributable to asset allocation and 1.06% can be attributable to security selection. So this helps us make future investment decisions and helps us to identify which part of our investment processes we're really doing well in.